Today, we're not just looking at numbers on a page, we're really examining a major shift, a transformation.
That's right. We're diving into EGE GÜBRE SANAYİİ A.Ş, ticker EGE and their Q3 2025 consolidated results.
And the big story here, as you mentioned, is how this company has completely changed its focus. It's fascinating.
It really is because, we're talking about a move away from, let's say, the volatile world of commodity manufacturing.
Fertilizers, right.
Exactly. And moving towards infrastructure logistics. Capital intensive, yes, but often seen as, well, maybe more stable.
So our mission today is to unpack those key figures, all inflation adjusted using TMS 29, which is important, and figure out, is this massive bet actually working?
We'll look at the pivot itself, the huge investments they've made, the cash flow, and a really significant accounting factor that played a big role in their net profit.
Absolutely. And hey, if you find this analysis useful as we go through it, please do give us a like, subscribe if you haven't, and share this deep dive. It really helps us out. Okay, so let's start with the basics. The company's DNA, if you will. Who is EGE? Or maybe who were they?
Well, traditionally, EGE GÜBRE was a big name in Turkish industry, headquartered in Izmir, Konak specifically, with their main production plants out in Alyasa.
And known for?
Composite fertilizers, that was their bread and butter for a long time. Also, organic solvents. But, and this is crucial for the story today, they also had port operations.
So the logistics side wasn't entirely new then?
Not entirely new, no. They provided jetty services, loading, unloading ships, and storage, bulk storage, including, interestingly, petroleum products in their tank farm. So they had a foot in the logistics store already.
Got it. So they were kind of straddling two sectors. Now, what about ownership and control? Who's running the show?
It's pretty clearly controlled by the Gencer family. Gencer Holding AG has about 40.77%.
Okay.
And Recep Gencer holds another 13.12% personally. So that's a majority stake. The rest, about 46%, is public float.
And I remember seeing something about voting rights.
Yes, that's interesting. The Class A shares, which are presumably held by the core owners, get 3 votes each in the General Assembly. It helps cement control.
Right, a common mechanism. And the corporate structure itself, does it reflect this logistics focus now?
Increasingly, yes. Their main subsidiary, TCE EGE, which handles the container terminal, is 100% owned and consolidated. That's where a lot of the growth is.
Okay.
They also just started an insurance brokerage subsidiary, EGE GÜBRE SANAYİİ, literally just launched in October 2025, plus some smaller, non-consolidated investments in related areas like warehousing.
And the board. Management structure.
Pretty stable. It's a 9-member board,
Yeah.
and it's good to see some diversity there. 2 women members, Buka Gencer Şahin and Güler Islamoğlu, who's independent. That's roughly, 22% female representation?
Okay. Now, you mentioned G&A costs earlier. There was something surprising about executive pay.
Yes, this really stood out, especially with high inflation. The total benefits for top management and the board for the first 9 months of 2025 actually went down.
Down. Even inflation adjusted.
Even inflation adjusted. It was about TL 43.8 million compared to TL 53.4 million for the same period in 2024. That's quite unusual.
Suggests maybe tight cost control at the top.
No.
Or fewer bonuses, perhaps.
Could be either or both. It definitely warrants a closer look. But overall workforce size seems stable, around 493 employees, pretty much the same as the previous period.
Okay, let's pivot ourselves now to the main event, the strategic shift. This seems like the absolute core of the story.
It absolutely is. This is the moment everything changed. November 10th, 2023.
Right.
They announced they were indefinitely halting chemical fertilizer production. Just stopping.
Indefinitely. Not selling it off, just halting. Why?
The official line was the crazy volatility in global raw material prices for fertilizers. And as a result, demand within Turkey just wasn't there anymore. It had contracted significantly.
So they basically shed the risk of that entire market.
Exactly. They stepped away from the unpredictable commodity cycle. But of course, that means
They're all in on logistics now.
Yeah.
The port business has to perform.
100%. Their future is tied to the port. So how is it performing?
Well, the numbers look pretty strong, actually.
They do. Very strong.
Mm-hmm.
If you look at loading and unloading volumes for the first 9 months, year on year.
Up about 9.6% to 2.73 million tons.
Correct. Solid growth. But the real eye-opener is container handling. That's measured in TEUs, the standard 20-foot container units.
And that was
Up over 30%. 30.1% to be exact, hitting 477,322 TEUs compared to about 367,000 the year before. That's huge growth.
Wow, okay. But growth like that doesn't just happen. You need to invest heavily, right? Build capacity.
Massively. And the CapEx figures in this report are quite something. They poured money into the port infrastructure.
Like what specifically?
Over 1 billion Turkish lira TL, 1.07 billion just on extending 2 of their jetties by 100 meters each. That's major construction.
1 billion lira. Okay.
And then cranes. They bought 1 big STS, ship-to-shore crane, and 3 new yard stacking cranes. That cost another nearly TL 727 million.
And are these operational yet?
Yes, the report says they were delivered in August 2025 and actually started working in October 2025, so they're contributing now.
And they're not stopping there.
Apparently not. They've already signed a deal for another big Liebherr crane costing 6.1 million euros expected in 2026.
Euros, okay. That ties into the FX risk we need to talk about later.
Definitely. And there's more infrastructure. They're planning a 1.5-kilometer rail link to connect the port directly to the main rail network. The feasibility study is ongoing.
So it's a full court press on expanding the port's capacity and connectivity.
Absolutely. They are betting the farm, so to speak, on logistics.
Which, feels like swapping one kind of risk for another.
Right.
They got rid of commodity price volatility.
But took on exposure to global trade volumes, macroeconomic cycles, competition between ports.
Exactly.
Yeah.
What happens if there's a global slowdown? They've got all this expensive new infrastructure potentially sitting idle. That's the gamble, isn't it?
That is the core challenge, yes. Their success is now tightly linked to sustained trade growth, both regionally and globally. But looking at the income statement for this period, the strategy seems to be paying off, at least for now.
All right, let's dig into those profits then. How did the top line look? Net sales.
Net sales, or Hasılat, came in at TL 2.645 billion for the first 9 months of 2025.
And compared to 2024?
It's up about 5.6% year over year, inflation adjusted. So modest growth on the top line.
Okay. And gross profit?
Gross profit, brut car, followed suit. It reached TL 1.134 billion, up from TL 1.083 billion. Margins holding steady there.
But the key point here is where that profit is coming from, right?
Absolutely. The segment breakdown tells the whole story. Almost all of that revenue, TL 2.644 billion, and virtually all the gross profit, TL 1.133 billion.
It's all from Lehman Hizmetleri Port Services.
Precisely. The chemical fertilizer segment is now basically a rounding error. It contributed next to nothing. The pivot is complete in terms of operations.
Okay, moving down the income statement. Core operating profit, İsas Faaliyet Karyan.
That showed stronger growth. It hit TL 773.17 million, which is up about 9% from the previous year. So they're managing operating costs reasonably well relative to the gross profit increase.
Speaking of costs, what about general and administrative expenses? Anything significant there?
G&A was up slightly year over year, about TL 537 million total. The biggest chunks, not surprisingly, were personnel and board fees. That's about TL 332 million.
Okay.
And then depreciation and amortization, about TL 33 million, likely reflecting all those new assets coming online.
Right. Makes sense. But now we get to the really interesting part below operating profit. The net income figure had that huge jump, didn't it?
It did, a massive jump, but a big chunk of that wasn't from operations itself. It was from the inflation accounting adjustment, TMS 29.
Explain this net monetary position thing again. It sounds complex, but it had a huge impact.
It did. So under TMS 29, companies in hyperinflationary economies have to adjust for the effect of inflation on their monetary assets and liabilities. Think cash, receivables, payables, debt. In 2024, EGE GÜBRE had a large loss from this adjustment, TL 355.1 million, because their monetary assets lost value faster than their monetary liabilities in real terms.
But this year, 2025.
It completely flipped. They recorded a gain of TL 75.7 million, a positive swing of over 430 million lira.
Why the massive reversal? What changed?
It likely means their balance sheet structure shifted, or the way inflation impacted their specific monetary items changed. Crucially, if you hold more monetary liabilities, like debt, than monetary assets, like cash during high inflation,
The real value of your debt shrinks faster.
exactly. The debt becomes easier to pay back in real terms. And TMS 29 recognizes that gain from the shrinking real value of your net liabilities. EGE GÜBRE likely has significant net monetary liabilities in this period,
So that accounting gain, plus the decent operating profit growth from the port.
combined to produce that huge jump in net period profit, net donum karu. It soared 78% year over year to TL 438.6 million.
And earnings per share followed.
Naturally, EPS almost doubled, going from TL.0246 in the first 9 months of 2024 to TL.0439 in 2025.
Wow. Okay, so a strong bottom line, but heavily influenced by that inflation accounting standard. Let's check the balance sheet now. Is the company financially healthy overall? Assets.
Total assets grew, as you'd expect with all the investment. They reached TL 9.742 billion at the end of September 2025, up from TL 9.334 billion at the end of 2024.
And that growth is mostly in
Non-current assets, Matty Duran Varliklar property, plant and equipment, basically the new jetties, the cranes, all that CapEx showing up on the balance sheet.
Makes sense. What about cash? Are they liquid?
Very. Cash and equivalents remained high at TL 1.038 billion, pretty stable from the end of last year.
But where are they keeping that cash?
That's important. The vast majority, about TL 886.7 million, is held in foreign currency term deposits, mostly dollars and euros, presumably.
Okay, holding FX cash. We'll come back to why that matters. Anything else notable on the asset side? Inventory.
Inventory, Stockler, dropped significantly, down to just TL 9.1 million from nearly TL 30 million, which makes perfect sense.
Because they stopped making fertilizer. No need for raw materials or finished goods inventory in that segment anymore.
Exactly. It cleans up the balance sheet in that respect.
All right, let's talk liabilities. Debt, Borsuluk. How leveraged are they?
Total financial debt actually remained quite stable, around TL 1.278 billion. Not a huge increase despite the massive CapEx.
How'd they manage that? Did they fund the CapEx internally?
Partially, perhaps, but there's a crucial detail in the maturity of the debt. This is really important.
Okay.
While total debt is stable, the amount of long-term bank loans maturing within the next year, the short-term portion absolutely exploded.
Exploded how?
It went from only TL 33.6 million classified as short-term at the end of 2024 to TL 454.2 million now.
Whoa. So nearly £500 million lira in long-term debt is suddenly coming due soon.
Within the next 12 months, yes. That's a major shift in their repayment profile. It means they need significant cash flow or refinancing capability in the near term.
And they did take on some specific new debt for the investments, right?
Yes. The report mentions a specific $25 million loan facility they drew upon for the jetty extension project. It's a 4-year loan with a 1-year grace period.
A dollar loan. For an asset-generating lira revenue. Which brings us back to FX risk.
Precisely. They have TL 886 million in FX cash, which sounds like a good hedge, but when you factor in all their FX liabilities, including that new dollar loan and potentially others, their overall position has flipped dramatically.
Flipped how?
At the end of 2024, they had a small net FX asset position, about TL 145 million more FX assets than liabilities.
Okay.
But as of September 2025, they now have a large net FX liability position of PL 576.1 million. Their FX debts now significantly outweigh their FX cash and receivables.
So that dollar loan and maybe other FX costs tipped the scales.
It seems so, and the report even quantifies the risk.
What does it say?
It states that a 10% depreciation of the Turkish lira against the US dollar and euro would cause a pre-tax loss of about TL 57.6 million, hitting profit and equity directly.
So they're quite vulnerable to lira weakness now. That's a significant risk factor tied to this investment strategy using foreign debt.
It is. It's a key risk investors need to watch. However, despite this FX exposure and the maturing debt,
their overall equity position is still strong.
Very strong. Total equity, Özkanaklar, stands at TL 7.951 billion, up from TL 7.697 billion at the start of the year, even after paying out dividends.
Yes, dividends. Do they pay one?
They did. Quite a substantial one, actually. TL 199.16 million paid out during the period. That was based on 2024 profits, representing a 180% gross dividend yield relative to nominal share capital. So they are returning cash to shareholders.
Okay, strong equity, but rising short-term debt and significant FX liability risk. Let's tie this together with some key ratios. Liquidity first, current ratio.
This is where that debt reclassification really shows up. The current ratio, which compares current assets to current liabilities, took a nosedive.
How bad?
It went from a very comfortable 6.74 at the end of 2024 all the way down to 1.82. The liquidity ratio, quick ratio, shows a similar drop to 1.81.
Wow, on paper that looks alarming. Like they suddenly can't cover their short-term bills.
It looks alarming, but you have to understand why it dropped. It's almost entirely because that huge chunk of long-term debt, the TL 454 million, got reclassified as a current liability because it's due within a year.
So the underlying total debt didn't change much just when it's due.
Exactly. The denominator in the ratio suddenly got much bigger. A ratio of 1.82 is still generally considered healthy. It means they have TL 1.82 in current assets for every TL 1.00 of current liabilities. They can still cover their short-term obligations.
Okay, context is key there.
Sure.
What about leverage ratios? Debt to assets?
Those look very solid. Total debt to total assets is low and stable at just 0.18 or 18%.
So assets cover debt many times over.
Right. And equity to total debt is incredibly strong at 4.44. This confirms the company isn't over-leveraged overall. They have a very solvent structure, lots of equity backing the debt.
Good. And at profitability ratios, we know net profit jumped. How did that translate?
All the main profitability ratios improved significantly compared to 2024. Sales profitability, operating profit net sales, nearly doubled, going from 0.17 to 0.32.
So they're getting much more operating profit out of each lira of sales.
Correct. And return on equity also basically doubled, from 0.03 to 0.06 for the 9-month period. Again, driven by that strong port performance and the big TMS 29 gain.
So the pivot is showing up positively in the profitability metrics, even with the accounting boost. Any other critical notes from the report we should mention? Legal issues?
There are a couple of ongoing lawsuits mentioned challenging some past General Assembly decisions, but the report notes the court's rejected request to suspend the execution of those decisions.
So limited immediate impact.
Seems so. They've set aside a provision of about TL 6.7 million, which isn't material given the company's size. They also confirm they comply with all mandatory corporate governance principles.
Okay, so wrapping this all up, what's the core narrative for an investor looking at EGGB today?
The narrative is one of successful, decisive transformation. EGE GÜBRE isn't really EGE GÜBRE the fertilizer company anymore.
Right.
It's effectively become a rapidly growing port operator. They've backed this pivot with massive capital investment, funded partly by new debt, which introduces FX risk and near-term repayment needs.
But fundamentally, they remain highly solvent with strong equity. And profitability has surged thanks to both the port's operational strength and that significant inflation accounting gain.
You really have to view them through an infrastructure and logistics lens now. Forget the fertilizer history almost.
Which leads us perfectly to our final provocative thought for you, the listener, to chew on.
If EGE GÜBRE has truly committed, invested billions, and effectively halted its legacy business, who are its real competitors now?
Exactly. If they fully exit fertilizer, they're squaring up against established port operators and logistics giants, maybe regionally or even beyond. Who should investors be comparing them to now? What's the new peer group?
That's the question to ponder. Who are their rivals in this new capital-intensive game?
It's definitely food for thought. Well, that's all the time we have for this deep dive. Thanks so much for joining us.
Our pleasure.
Remember, if you found this breakdown helpful, please hit that like button, subscribe for more, and share it with anyone else who might be interested. It helps us keep these deep dives coming.
We appreciate the support.
We'll see you next time on The Deep Dive.